So this right here, this is where you want to be, right? Let's just use bar replay for this quick. Awesome. So we're going to use this as like an example for the strategy, right? Now, granted, in hindsight, benefit of that, we already know where the market is going to be trading towards, right? We already know what we're looking for, but let's say we didn't, right? And this was like bare clean chart, and we don't know what's about to happen, right? So what do we do is, first thing, we mark out PD arrays that price could be thrown towards, right? So here we have this right here. This would be your sell side imbalance, right? Your CB, your fair value gap, however, whatever term you use to identify this is fine, as long as you can identify it, right? So this would be our throw for our higher time frame PD array. Now we could have used this one as well, but as you can see, market is basically already there. Market is already basically disrespecting this because it's about to close above, right? Like if you saw the next candle, you'd know it's going to close above, which granted we shouldn't have seen, but here we are, right? Also, this is something that you need to do. I'm just teaching you how to backtest all these, right? Also, this right here, this is Monday the 5th and we are trading Tuesday, right? This is London, this is where we want to be. So this here would be considered as a previous day low, which is also a draw on liquidity, right? So we do this, we do it like this. And we can even say, can even mark that out as liquidity, put that right at the bottom. Okay, so now we know how to draw on liquidity, right? It is Asia. Let me just mark this out again so that it's like I'm marking it out with U's as well. Great. So this range right here, there's a reason why we use this range specifically, and I'll explain that now. So this right here, this would be your Asia session low, and then next candle, boom, this would be your Asia session high, wherever this candle like just closed above now. You would mark that out as your high. So we mark this out like this. Okay. Okay. So where was I? Oh yes. So the times that we use, right, it's from 6 p.m. till 12 p.m. This is New York time, right? And we mark this out as our Asia range, right? This is our Asia session, right? And then the times that we are trading is from this time from 12 p.m. till 6 a.m. From 12 a.m. to 6 a.m. Sorry, this is all New York time. I know in the PDF it states from 7 till 12 and from 12 to 5, but we use 6 p.m. previous day because this is the day that the market actually opens. So from a Monday to a Friday, the market is open, and then it closes Saturday and Sunday, and it opens Sunday night again at 6 p.m. So this is true market open. That's why we use it, right? And then why it's 6 a.m. and not 5 a.m. is because that's basically the last hour. From 5 till 6, that's the last hour. You don't really want to be taking trades day in, right? So these are the actual hours. But the reason why it's 5 is because, like I said, you don't actually be taking trades there because it is coming towards the end of the session, right? So yeah, and we only allow ourselves from the time of 3 a.m. till about 6 a.m. to actually enter a trade. More specifically 3 a.m. to 4:30 a.m. But we give ourselves that like extra hour just because that. So if you're not in a trade by 4:30, then chances are you're not going to be in one but 3 a.m. to 4:30 is basically where we want to be, right? So we'll mark this out as our kill zone at 3 a.m. to, we'll say 4:30/6, no? Right. So this right here, this is our kill zone. This is where we want to be in, right? And in regards to this 1 hour fair value gap, just like this. So you would want to refine this on like the 15-minute, for example. You could refine it to possibly this, but for me this is fine. There's nothing that really aligns within this 1 hour fair value gap that you can refine it to, apart from this one right here, apart from this one, this 15-minute one right here. So that's why I won't refine it, right? So we're anticipating bearish prices because we already know the market's going down. We've seen on the 1 hour, determined our bias, right? We've determined something that the market could likely throw towards, and also sweep liquidity, which would be this previous session high or this previous session low, right? But preferably the high, because we are looking for sales, right? So those are our factors that we're looking for. So now all we do is we wait, right? Market throws higher, comes back lower, and then boom, instantly when this candle closes, right, you can either instantly execute this or you can wait. So you'd either go down to a lower time frame or you wait for the next candle to be a rejection like this one, right? So with this, now we go down to the 5 minutes and then we see now, right? So first thing that you would notice straight off the bat would be this fair value gap here, right? Now there's nothing wrong with taking this one as it is. You can, by all means, as soon as the market retraces, which I think it does next candle, as soon as the market retraces and closes, you can enter this. There's no if, buts, or maybes. You can enter this, right? But if you want to stick to the rules, if you want to stick to your trading plan, you want to instill confidence and stuff, you will wait for this time. You'll wait for 3 a.m., right? There's another reason why you choose 3 a.m. as well, because something significant happens from 3 a.m. to 4 a.m. That's your ICT silver bullet. So market will either like sweep liquidity or rebalance an inefficiency of some sort, right? So at 3 a.m. you could expect either this to be swept, or you can expect this to be rebalanced again, or another PDRA or another imbalance that forms here, right? So that's why we pick 3 a.m. to 4:30 a.m. right? Or till 6 a.m. That's why we start from 3 a.m. to actually enter in a trade, right? So we would still be waiting. We'd be waiting, still waiting, and then right here, what do we see that market could gravitate towards besides this? If we want like another added area, right, another added confluence perhaps, would be this, right? So we'd mark it out like so, and then we'd mark this as an inversion fair value gap, right? So we've marked these two out now, right? We don't know which one the market is likely going to come and retest. It shouldn't be this one, as the market has already filled it, but the market can retrace back towards the just one last time, right? So now you'd still be waiting, hasn't retested anything yet. You wouldn't enter anything. This is the hard part, the waiting game, right? Having patience. So first candle, right? Immediately when this candle closes, it taps this fair value gap and it taps this inversion fair value gap, right? So immediately, as soon as this one closes, you would go short. You'd look for sales. You'd enter in the market as a sell, right? So you'd either put your stop loss right here, or you can put it above this high, right? Whichever one is more comfortable with you. And then in terms of take profits, what you would aim for is, if you want your psychology to maintain perfectness or perfection or whatever you want to call it, you want to be confident, you don't want to stress about the market, you would aim for a solid 1 to 2, right? Solid 1 to 2, so that means you'd be risking 1%, aiming to make 2% from this, as stated here, risk reward 2, right? Or you would aim for this right here. This would give you a nice like 3.6%, aiming for your session low, right? So with this, you could have entered right at the close of this, or if you were you wanted a more aggressive entry, you could have entered right here at the tap of that, and as soon as you saw a market starting to retrace down lower, this is where you could have entered it, right? And then this would have given you like a 5.97, almost a 6%, right? But for the sake of this lesson and for the sake of keeping things authentic, we are going to do it like this, right? So then your stop loss, we put it like about there, and then take profit, yeah, right. Now in terms of your take profits, this, your Asia low would be your take profit 1, right? So you can make Asia. So TP is just a shortening of take profit, right? As long as you understand what it means, you'll be fine. And then in terms of if we were aiming for something else, we would be aiming for this previous day liquidity, right? So now we just watch how the market goes, right? So second candle, a nice bearish candle rejection, and then this one as well. That's a pin bar or ham, if I'm not mistaken. And then you would smash your take profit right there, right? You would have been out of the trade, or if you were still holding, you would have taken about 50 to 75% off of your original position, and you would have left the other 25% to run for this previous day low right here. So if we play price on, and also all these PD arrays that you see, like all these imbalances, you want them to be disrespected as price is moving towards your target, right? You can even use them as scale ins, because if you see at this one right here, for example, this inversion fair value gap right here, you can see market comes, boom, retests it, closes, and then you would have entered maybe another short position if you were anticipating price to come here, right? But if you only took one trade and you are holding, either you didn't jump out here and you are holding for this, you would still be there. Your stops would be, you would put your stops like at break even, so your stop loss would probably be like here, right? And then as the market goes on, we see higher prices, and then boom, right here over this candle right here, we would have taken out the previous day low. So this is basically the characteristics you're looking for in price every day. It's not going to change, it never does change. This is basically how I anticipate price. So this is going to be basically the end of this lesson. Within next week, I'll probably share setups, maybe share another or a few more backtesting videos on price and whatnot. Also, another added confluence, and this is going to be like a nugget for those that actually watch this, and this is also going to be in conjunction with like future like lessons that I have. Another reason why you choose this higher time frame imbalance, right, is because of the time, right? So what do I mean by that, right? Time and price is everything. So time or price tends to react off of time or where time is, right? So if we are looking to trade between the time of 12 and 6, right, what are we looking for in previous data? right? So this would be Tuesday. Then right here, this is 6 a.m. and this is 12. So this is your previous day London session, right? And just mark this out like this so that you have a more or better understanding on it, right? And then just color this in there, right? Now your London session will either like create the high or the low of the day. So with this, you can see London like rated the high, New York rated the low, right? So because you want to be trading, or because we want to be trading within this time of 12 and 6, we look for a PD array that formed within the time of 12 and 6, which would be this one. And as you can see here, the market comes back, it respects it, and this is just like another added confluence, right? Thus having this PD array within the same times, right? This is just another added confluence. And if you see where this PD array formed was 4, you can say at the end of 3 and the beginning of 5, and then you would enter here at 3. So you see timing and price is basically everything, but that is a bit more how do you say it now? That's going a bit more into it. Yeah, so this is basically I don't know what's happening here now. This is basically how you want to anticipate time and price, and these are all the characteristics that you want to see happening within price, right? So if you are bearish, look for a bearish PD array, sweep of liquidity to the upside, and then you're going to take it down, right? What the fuck is going on here? Okay, yeah, cool. So yeah, also the market has like different sessions all within like 6 hours. So Asia, and then London, and then New York AM and New York's PM, right? And all these times, as I've said before, these are times that we use in New York time, so you would have to convert them for yourself. Just type in like on Google. Basically, you can do it like yeah, you can do it. So also what we are looking for is you see this tight consolidation in Asia, right? Like it's a very tight spread, very rectangle. There's not like a lot of movement here. This is what you are looking for when it comes to Asia specifically, because what can tend to happen is maybe Asia is a move like this, right? If Asia is a move like this, and then for example this would be maybe London that's like expanding higher, then you'd only find a trade within New York. But we don't trade New York, or you guys don't trade New York, so you wouldn't be looking for any setups in that day if price were to do that, right? Which is something that you will have to be accustomed to. It's something you'll have to get used to. Fear of missing out is an actual thing in the markets. So FOMO, you'll have to curb that, because you'll get setups, not every day, but frequently you'll get setups. You'll have to make do with the days that you don't get setups. So the thing, or the secret to Forex, is you want it to be boring, because if you're still finding excitement in it, then chances are that things are going to go wrong and whatnot. But if you're looking for the same things that occur at the same, not at the same time, but the same things that occur every day or occasionally, very frequently, then you will be fine, because you know what to look for. You know where to pinpoint specific things that are happening, right? So yeah. And what else? What else did I want to tell you guys as well? I think I'm gonna leave it at that, right? Please do, when you watch this video, make notes. Do this like on your chart as well. It's very important. At least spend like an hour a day practicing, right? All the information and the strategy and this video is going to mean nothing if you don't put in the work, right? So that's a very important, I can't stretch that enough. If you want to be, or if you want to make it in the game, right, you need to put in the work. So you need at least an hour. So what we are using here is this entire application. This is TradingView. You can get this on your laptop, you can get this on your phone. It works on both basically. Yeah, your first month they give you a free subscription for your replay button. So this is where you can go and backtest previous data and whatnot. They give you like 30 days for free. Another app you can try that's completely free is like Go Charting, and I think, what is it, Think Trader, Think Markets, something like that. I haven't really used those, so I don't really know how they work. I don't know how they work all too well, but yeah, you can give those a try, and then set your times accordingly. Like you can see here, UTC -5, which is New York time, and then all these, you just like these times here that we use, you'll just convert them to South African Standard Time. And yeah, also let me just show you guys this before I do end this off. So this right here, these two consecutive up close candles, we would consider this as a order block, right? Why? You have this swing point right here. This can act as liquidity, right? You have all these there's 2, there's 3. You have all these fair value gaps here that form after the creation of this order block itself, right? If you were to take this as a scale in, what do you target? You're targeting previous day liquidity. This candle and this candle didn't take it out yet. It came close, but it did not take it out yet. So you possibly use this as another scaling in option until you reach your draw on liquidity, right? So let's just delete that, take all this off. So yeah, so this is where I'm going to end this lesson. I will, in the group, I will put more examples, maybe a bit more complicated examples like in reversals and whatnot, because this one right here, this would be something you would follow, because this is following order flow, this is following the trend, right? They always say the trend is your friend, not always, but most of the time it is. So when you find like a trending market, that's the market you want to be in. If you find a market like on a higher time frame, if that market is looking like this, like Asia is looking, then you don't technically want to be in that market, because you're not really going to find good setups. Versus like this one that was following the momentum of the market, like down, breaking lows, breaking more lows, so on and so forth. This is what you want to look out for. So please do, this would basically be your homework. Please do your homework. Yeah, when you backtesting, look for these specific characteristics. When it sells, look for these characteristics. When it buys, just look for the polar opposite of this, right? Look for fair value gaps, order blocks supporting higher prices, all those, right? So yeah,